All right. So as you know, we've been walking down Apple's balance sheet, right? So we started with chapters 1, 2, and 3, where we talked about the overview of the accounting process, the debits, the credits, the creating the adjusted journal entries, and then creating the financial statements, the income statement, statement of retained earnings, and then the balance sheet. There's a fourth one that we haven't talked about. We will get to it, hopefully back on campus by that time, but who knows, the statement of cash flow. So then we started kind of walking down in chapters 4. We covered cash and cash equivalents, and then we covered a part of Appendix E with short-term investments and accounts receivable. And then chapter 6, we did inventories, right? So we covered all of our current assets. Then we took a test. And then we came back and we talked about fixed assets. So this net means that it's net the historical cost minus the contra asset, the accumulated depreciation. So now we're going to talk about marketable securities. Okay. So marketable securities, this is just a fancy term for long-term investments. And if you look, right, and this is over a year old. But a year ago, Apple had $158 billion in long-term investments. So let's just pause and think about that for a second, right? Because they've got it's 158 billion in long-term investments. Okay. Plus they've got another 42 billion in short-term investments. So that is, oh, someone help me out, $199 billion. Yes. Yes. $199 billion. Now let me just.
I got 200.
Is that 200?
200,264.
Okay. 199, 200 bill. You guys think I know how to erase on this thing? Oh, I don't. Okay, 200 billion. So just think about that for a second. At what point in your personal life do you say, I'm going to start investing? When are you at a point where you can start investing?
When you're 18.
When you're 18? Okay, that's part of it, yeah. You can invest before
when you have money that you can just kind of throw around, I guess.
That's exactly it. Yes, right? You can't, I mean, it doesn't make sense to start investing if you're making $4,000 a month, but your expenses are $4,100 a month. You can't invest. You don't have enough money to invest. So you start investing when you go, look, I've got this money coming in, and then I'm covering all my expenses, and I still have some money left over. So therefore, I'm going to start putting that money into a savings account, putting it into an investing account, and start investing that additional money. Now, let me ask you this. When do you say, so what's a long-term investment mean? Long-term, what is long-term?
Like an index fund or something that grows gradually over an extended period of time, like the S&P 500 or something.
Yes, so an extended period of time. In accounting, what's an extended period of time?
More than a year.
More than a year. So again, right, let's think about this. From a personal perspective, we're investing our money and we go, you know what though? I don't think I'm gonna need this money for like at least a year from now. So this is money I'm not planning to use until 2021, right? So that's when you start doing long-term investments. So you got some money that you're spending, right? Day to day, month to month. You've got money that you've got in your savings account in case something comes up, I need to access it quickly. And then you've got money that you go, I'm not going to use that for at least a year or more. Apple's got $158 billion. They go, I don't think we're going to use that for like a year or more. I just think that's fascinating. Apparently you don't, so let's move on to the next one. So when we talk about short-term investments, right, it is less than 1 year. right? Same concept. And if it's long-term, more than 1 year. Let's see, you all aren't seeing what I just wrote here. I'm gonna pause the share. I'm gonna resume the share. See if that helps us a little bit. All right, so I was here, I lost connection. And we were talking about short-term is less than 1 year. And long-term is more than a year. And you guys still can't see what I'm writing, can you? No, you cannot. All right, let's see. Oh, there it is. We just have a little bit of a delay. So when we were talking about investing, when we were in chapter 5 and we touched a little bit on investing, we talked about three different types of investing. There were trading securities, and then there were available for sale securities, and then we had held to maturity securities. Okay. So we talked about trading, right? And all this kind of hinges upon what is management's intent. What is management's intent, and what is management's ability? And when it was a trading security, they intended to hold it for a short period of time in order to generate a profit. When it was held to maturity, they intended to hold that investment until it matures. And what that means is that there's some sort of contract or some sort of term attached to this investment. Can anyone think of an example of an investment that has a term attached to it?
A VC fund investment?
A VC fund investment. Tell me more.
Isn't there like a contract, like they will hold it until IPO?
Okay. Yeah, so the difference there, Jassim, is that the IPO date is an indefinite date. And I'm thinking about let's think about a
CD.
investment that has a definite date. I'm sorry, what'd you say, Noe?
A CD.
A CD. That's a really good example. So a CD, or a certificate of deposit, it's a type of a savings account that you can get with your bank, where you go, I'm going to put this money into this instrument, this investment. You're going to agree to pay me a certain amount of interest for a certain period of time, right? Let's say it's a 3-year CD, and it's paying 1.5% interest. So by doing that, and you're saying, I intend to hold this investment all the way through the end of the term until it matures. That would be the 3-year term. Okay. And then I also have the ability to do so. In other words, when you look at my cash flow, this is money that you wouldn't expect me to need in the next 3 years, because I have the ability to hold it to maturity. Okay. The other investment that has a maturity, and this is the one that we're really going to focus on, are bonds. So let me just go to my whiteboard. And let's talk about bonds. I presume you all have heard of the term bonds before. right? Stocks and bonds. But are you guys familiar with how bonds work? Is anyone familiar with how bonds work?
Yeah, you basically loan the government a certain amount of money through buying the bond, and you promise them that they can use that money for a certain period of time, which is the length of time that it takes for the bond to mature. And once the bond matures, they give you the sum plus the interest.
Oh my God. Brad, you should just be teaching this class. That's exactly it, right? So with the bond, right, it's you saying I'm investing in the government or a company. Companies can issue bonds as well. And I'm giving them money in exchange. They're going to give me interest, right? So the advantage, and so I don't know if you guys have heard this concept, but stocks and bonds kind of work opposite one another. Stocks are less predictable, right? So when the stock market is doing great and you can earn 6, 7, 8, 9%, no one wants to invest in a bond that says, hey, guess what? We'll pay you 4% every year. Ooh, you go, I don't want to do that. I want to invest in stocks because that's going to go up, up, up. So when the stock market is doing great, the bond market is not doing so well. In times like now, when the stock market is not doing great, right? It's having its ups and its downs. And you go, wait a second, you mean to tell me I can invest in a bond and just guarantee 4% interest? That sounds great, right? So then the bond market goes up and the stock market goes down because everyone wants to invest in bonds. Let me illustrate to you an example of kind of what it looks like. So let's say that on January 1st, a company invests $10,000 in a 10% bond that's going to last for 3 years.
I can't see what you're writing at all.
Yeah, and neither can I. Well, I can, but let's see if I pause the share and I resume the share. Let's see. Stop share. All right. So January 20th, $10,000 bond, 10% for 3 years. Okay. And let's assume that it's being paid annually. Interest is paid annually. So you'll see that a company can pay interest on an annual basis, on a semi-annual basis, that would be twice a year, on a quarterly basis, on a monthly basis, right? This is a contract that the issuer, the person borrowing the money, is entering into with you, the person who's investing in them. So this 10,000 is what we call the par value. This 10% would be our coupon rate. Okay. This is also known as the interest rate. And remember, whenever we see percentages, right, we're always talking about an annual percentage. So every time you see this, it's an annual percentage. What I mean by that is even if it's being paid semi-annually, it's still going to be 10% for the year. So semi-annually, you'd get 5% in the first time, 5% the second time. If it was quarterly, you'd get 2.5% the first time, 2.5 the second, 2.5 the third, 2.5. And then this is called our term. Okay? So it's for 3 years. So here's how this works, right? So I'm going to demonstrate it in as journal entries. So on January 1st of 2020, right, we would debit, it's called our bond investment, our held to maturity investment. Okay? And we always record our investment at its cost. What did it cost us, right? So this was a $10,000 bond, and obviously we have to spend cash to make an investment. So we've got this bond here. This is an asset. That's $10,000. When we get to the end of the year, so what happens is, and this is how bonds work. I want you guys to just have a visualization of how bonds work. So when we get to the end of the year, the company is agreeing to pay us interest, right? They're going to pay us interest once a year, annually, for 3 years, the term. And the amount of interest they pay is the coupon rate times the par value. Okay? So 10% times 1,000 or 10,000 is $1,000. We're going to get that in cold, hard cash. And our credit is going to be to interest revenue or interest income. Your book calls it interest revenue. So 1 year has passed. We've earned, they still have our $10,000, right? Because they're using it to do something. But we just got $1,000 in cash. At the end of the second year, 12/31/21, right? They said pay us annually for 3 years. The interest they're going to pay us is the coupon rate times the par. Okay? So we're going to get another $1,000, and we're going to debit interest revenue for $1,000. How are we doing so far?
Good. Is there a way could you just possibly multiply the term by the coupon rate and then take it from the par?
Multiply the term by the coupon rate and then take it to the par?
Yeah, just take 30% of the par to get your ending interest rate.
No, we cannot. That's a good question. And here's why we cannot, right? Because we're still using oh, you guys love this term, the accrual basis of accounting. It says record revenue when it's earned. Okay. So even though over the next 3 years, I'm going to earn $3,000 in interest, at the end of 2020, I've only earned $1,000. And I have to wait till I get to the end of 2021 to earn my other $1,000.
I kind of missed why there's like 2 journal entries for the same amount.
So this is 2020, the first year we got paid. This is 2021, the second year we got paid. And there's going to be a third one as well. right? Because we get paid 1, 2, 3 times. So on 12/31/22, we're going to get, because we're getting paid annually, right? Every year, right? This is our last time getting our interest, which is the coupon rate times the par. So that is another $1,000 in cash. And we credit our interest revenue because they're paying us this because we're earning interest of 1,000. But something else is going to happen at the end of 2022. What is that?
We get our money back.
Earning interest.
In addition to earning interest.
We
What else?
get the principal back.
Yeah, we're going to get our par value back, right? So the other thing that happens on 12/31/22 is we're going to get the par value back, right? And then we're going to give back our investment. Okay? So when this is all said and done, our investment's going to be 0 because we're getting $10,000 in cash back. I'll pause for a second and let you all ask questions.
Can you put like the last 2 journal entries into just one journal entry?
Yes. If they're happening on the same day, then yes, you can.
All right, thank you.
So I want to, I'm going to stop sharing this because I want to show you all a video. It explains how bonds work. Let's see, where are you at? Video. Let's see if this is going to work. To share your stop that share. See, let me try it. Let me see if I can find it. They're telling me I need to install software. I'm not going to do that with you all on the phone. That could be like a all right, let's see if I can share this. To share a computer, please install blah, 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 blah. So you all can see this, but I'm assuming you won't be able to hear this.
Bonds are a common investment. However, to many investors, they remain a mystery. So let's explore what a bond is and how it might benefit your investment portfolio. A bond is simply a loan given to a company or government by an investor. By issuing a bond, A company or government borrows money from investors, who in return are paid interest on the money they've loaned. Companies and governments issue bonds frequently to fund new projects or ongoing expenses. Some investors use bonds in hopes of preserving the money they have, while also generating additional income. Bonds are often viewed as a less risky alternative to stocks and are sometimes used to diversify a portfolio. Consider this example. The city of Fairview wants to build a new baseball stadium, so it decides to issue bonds to raise money. Each bond is a loan for $1,000, which Fairview promises to pay back in 10 years. To make this loan more attractive to investors, Fairview agrees to pay an annual interest rate of 5%, which in the bond world is also known as a coupon rate. An investor buys the bond at face value for $1,000. Now, let's fast forward. Each year, the city of Fairview pays the investor $50. These regular interest rates continue for the length of the bond, which is 10 years. Once the bond reaches maturity, the investor redeems his bond, and Fairview returns his $1,000 principal investment. This bond was a good deal for both the city and our investor. Fairview got the money it needed to build the stadium. The investor received regular interest payments and the return of the original investment. Because a bond offers regularly scheduled payments and the return of invested principal, bonds are often viewed as a more predictable and stable form of investing. Compare regular payments of a bond to the experience of owning a stock. With stocks, profits and losses are driven by market forces and are generally less predictable. Of course, like any investment, bonds are not without risk. One risk that bond investors face is the possibility that the issuer defaults on paying back the principal. This is what is known as default risk. Typically, bonds with higher default risk also come with higher coupon rates. The amount of risk depends mostly on the financial stability of the issuer. For example, most governments are generally considered stable issuers and issue bonds with a relatively low coupon rate. Corporate bonds typically represent a greater risk of default, as companies can and do go bankrupt. That's why corporate bonds often offer a higher coupon rate. Several credit rating agencies assign rankings to different bonds. This can help bond investors to gauge the financial strength of the bond issuer. These ratings agencies often use different criteria for measuring risk. So it's a good idea to compare ratings when considering a particular bond. And keep in mind, rating agencies aren't always accurate. So be sure to research a bond and its risks thoroughly before investing. Another risk to consider is interest rate risk. This is the risk that interest rates will go up, and any bonds you own will be worth less if sold before the maturity date. After all, when interest rates rise, more investors allocate their money into the new, higher interest rate bonds. If you wanted to unload a low interest rate bond to take advantage of these new rates, you would have to sell your bond at a discount to make it a worthwhile purchase for another investor. Capital preservation and income generation are just two ways bonds might be part of a diversified portfolio. Many investors use a mix of stocks and bonds to pursue their investment goals. And because bonds move differently from stocks, they can help increase or protect portfolio returns. Keep in mind that this discussion showed you one simplified way that investors might use bonds, and only a few of the risks to consider. Like all investments, bonds are complex and have a variety of uses and risks. Before you invest in bonds, it's important that you invest in your own financial education.
I have a couple bonds issued in my name from like 2004 I just found. So I know what it like looks like and everything.
I'm sorry, say that again.
Investing in the stock.
Back in 2004, I don't know if my grandpa or my mom issued bonds in my name, but I have a few at like 10% interest.
Yeah, yeah. So that's
Kids in the back.
bonds are pretty common. No?
I'll let him do his thing.
Let him stay.
You want to say hi to the class, Lucas? Want to say hi to everybody?
Hi.
No? Okay, well then you have to get out.
Hi. Hello. You're so cute.
So, any questions about bonds?
Wait, Professor, doesn't the person who issues a bond pay the par value like on a monthly basis or when payments are due?
No, so what the investor is doing is paying a the person that's, let's look at it from an investor's perspective. So what the investor is receiving is just the interest payments every month. Okay. You guys give me 1 second. I have to go. Have to be a dad for a second.
So in the video, when it said another risk is that the interest rates can go up, who's going to be getting less money? Like the person who issued the bond or the person who's, if anyone knows? Oh, the investor. Okay, thanks.
All right. Did I answer your question, Jason?
Yeah, you did.
Okay. So, so the last part on that video, so I encourage you guys to watch that video like 2 or 3 times over the next 2 or 3 weeks, because there's a lot of like jewels in that. I just, if you go to YouTube, and I'll put it in the chat, just type in investing basics, bonds, TD Ameritrade. It's about a 5-minute video, 4-minute video. There's just a lot of good nuggets in there that you want to make sure you understand the concept of how bonds work. Now, what I want to do is, the last thing that they talked about was selling at a discount. So I want to do this example, but I want to show you what it looks like when you're selling at a discount, because the reality is bonds are rarely sold at their par value. So we were doing a bond that had a $10,000 par value, 10% coupon rate, 3 years. But let's assume it was sold at 97. So we know this is the par value, 10,000, and then this is the coupon rate, or the interest rate, an annual interest rate. This is the term. This 97 represents the price. And forgive us for wanting to be fancy, okay? But when you see 97, this means 97% of par. So in other words, you're buying this investment for 97% of its value. So if we were to look at journal entries, well, actually, let me step back. Let's talk a little bit about why a company would sell, because what's happening is the company's saying, hey, you give me 97% of $10,000, which is $9,700. You give me $9,700 today. I'm going to give you $1,000, right? Par times the coupon rate, $1,000 every year for the next 3 years. And then at the end of the 3 years, I'm going to give you $10,000. So why would a company do that? The reason why you sell things at a discount is because you want to entice investors, right? So we want to buy things at a discount, right? So they're having a sale. The reason why they have to have a sale is because I'm thinking, wait a second, I could take this $10,000 and I can earn something more than 10% somewhere else. So why would I pay $10,000 for this investment? And they go, well, don't pay $10,000. We'll sell it to you for $9,700. And I go, oh, okay, that's a good deal. I'll take that. Okay. So that's why we have a discount, is when the contract set up, that interest rate, that coupon rate is fixed. And as the interest rates fluctuate up, down, right, up, down, we see that it's either more advantageous to invest in the stock market or somewhere else, or it's less advantageous to invest somewhere else. We want to invest in the bond. All right, so let me show you what it looks like. So this was January 1 of 2020. When we bought it, right, we always record the bond investment at its historical cost. Okay, so our bond investment is what we paid for it, which was $9,700. And to get that what the cost, you take the par value times the price. Okay. It's 97. So you take 97% times 10,000, that gives you 9,700. So here's where the plot thickens, all right? So in 3 years, right, this is 1/1/20, right? In 3 years, 12, 31, 22, 22, how much are we gonna get for this bond? How much are they promising to pay us 3 years from now?
10,000.
10,000.
10,000. Which means between the next 3 years, we have to increase, okay, this bond by $300 so that by the time we get to 12/31/22, we can say debit cash for 10,000, credit the bond investment for 10,000. That's our 12/31/22 journal entry. So if I take this 300 and I divide it by the term, right? This is paid annually. So 300, and I'm getting paid. I don't divide it by the term. I divide it by the number of payments, right? So I'm being paid 3 times because it's 3 years and I get paid once a year. If I take 300 divided by 3, that equals $100. So this is what it all leads up to. All right, so 12/31/20, right? As an investor, I'm going to receive cash. How much cash am I going to receive from this transaction, from this bond?
$100 for the interest.
Yeah, how much cash do we receive?
1,100, right? Because the interest rate annually and then the extra payment you're getting.
Close, close, close. To get the cash received, it's the par times the coupon rate.
Oh, so 1,000.
So 1,000. Right? This contract says I'm going to pay you 10% of the par value. Coupon rate times the par value. That's the amount of interest you're going to get paid. But I also know that I need to increase my bond investment by $100. Because remember, and then over the next 3 years, every time there's a payment, I need this to go up so that I can get it to 10,000. So I'm also going to debit my bond investment by $100. And I'm going to credit interest revenue for $1,100. So now when I get to the end of 12/31/20, my bond investment is showing $9,800. I'm going to say one more thing and then I'm going to stop. I'm going to pause. This 9,800 is what is considered the amortized cost. Held to maturity investments are recorded at amortized costs. So I'm going to pause for a second, let you all digest that, let you all ask questions.
How do you, I guess my question is, what do you mean, how do you record an amortized cost? How is it recorded? I don't know what that means, I guess. What does the journal entry for that look like?
The 9,800?
Yes, I don't understand what the amortized, when you say it's held to maturity is recorded at the amortized cost, I don't know what that means.
Held to maturity, it's reported on the balance sheet at its amortized cost. So remember when we first met, right, I said assets are reported at historical cost. Whatever you paid for it is what it uses. And then I said, no, I'm just kidding. If it's a trading security, it's reported at fair market value. But everything else is at historical costs. And then I said, no, I'm just kidding. If it's a accounts receivable, it's reported at its net realizable value. So we have to estimate who's not going to pay us, right? So it's what they owe us minus our allowance for doubtful accounts. And then I said, I'm just kidding. For the fixed assets, property, plant, and equipment, that's reported at its book value. So it's historical cost minus the accumulated depreciation. And now I'm saying, I'm just kidding, if it's a held to maturity investment, it gets reported not at its historical cost, but at its amortized cost. And the way we get to that is this 9,800 is made up of this journal entry here when we first purchased it at its cost, and us recognizing the discount, part of the discount that we received 1 year later.
Oh, okay. So when we put out like our quarterly or annually balance sheet or whatever, we're going to record what the current cost is. The current cost of that asset is the amortized cost.
Mm-hmm. Yes.
That makes sense.
Is there a reason why, so for this one, on the debit, we separate the cash and the bond investment. But on the credit, the interest gain isn't 1,100. The interest is only 1,000. I guess it would be an amortized gain. Is it just because there's no account for that specific item, which is why we combine them together?
Actually, the interest is that is an additional $100 in interest. Because remember, right, if we play this out to conclusion, we paid $9,700 for this investment. And then when it's all said and done, we're going to get $10,000. So inherent or embedded in this investment is an additional $300, right? The difference between this 10,000 and what we paid for it. And we're again following the accrual basis of accounting that says, okay, as we're earning every year that we keep this investment, we're earning an additional $100 that we're not going to get paid until the end, right? But we still earned it in that period.
So at this point, what assets do we even have that are recorded at like historical cost? Because it wouldn't everything be fair market value
Well, we got supplies.
now?
Yeah. Well, no, so we got supplies. We got cash. Yeah, cash.
Land, right?
Land. Yeah, land. There's a few of them. There's a few sprinkled about.
Mr. Bill, where did you get 300 from again? Like you have 300 divided by 3.
So that 300 is the difference between the 10,000 and what we paid for it.
Okay. And you just divide it by the years.
Right. So let me show you what it looks like for 12/31/21. We're going to get cash. How much cash are we going to get?
$1,000.
Thank you. And that's the par times the coupon rate, right? The 10% times the par, 10,000. We're also going to increase our bond investment by another $100. Okay. And then the credit goes to interest revenue, 1,100. It's basically the same journal entry that just repeats every time we get a payment. And then 12/31. So now, let me just show you this. So now our amortized cost at 12/31/21 is $9,900. And then when we get our last interest payment, 12/31/22, debit cash for 1,000. Debit the bond investment for 100. Credit interest revenue, 1,100. Okay. So now we've got this 100 going here. So we've got 10,000 now sitting in our bond investment account. So when we do this journal entry right here, this thing goes from 10,000 to 0. What questions do you have?
So if we didn't buy the bond at a discount, like in the example prior, there would be no amortized cost?
Correct.
Okay, but that's not realistic, right? I mean, that's pretty much always, you're pretty much always buying at a discount because of interest rates.
Yes, you're either buying at a discount, or we're not going to get into this detail today, or you can buy it at a premium.
Okay, thank you, Professor.
But it's rarely going to be sold at par value. What other questions do you have?
So what would happen in a situation where you had to leave, like get out of the bond before it matures?
What would happen? You sell it. So, I mean, the reason why bonds are never sold at par value is because people are constantly buying and selling bonds, right? So at the point when this becomes a good deal, you know, this is economics, more people want to buy it, so the price goes up. At the point when it becomes a bad deal, I can earn 12% somewhere else, it becomes not a good deal, so less people want to buy it, so you have to lower the price in order to entice people to sell it. So people are, just like people are buy and sell stocks every day, they're buying and selling their right to a bond contract. They're saying, hey, I got this contract, this bond that's got another 6 years on it, I'll sell it to you, and then you can collect the rest of the interest payments and the par value when it's done, right? People are constantly buying and selling that.
If you sell early though, don't you typically take some kind of hit on your par value?
No, the par is set.
Okay, so even if you sell early, there's no negative aspect to that for the investor?
Well, what changes is the price.
Okay.
So that's being driven by what else could I do with this investment? So if I'm in a bind, right, and I go, you know, look, I own a restaurant, and because we're in a shelter in place through May 1st, I can't run my restaurant. I need $10,000. So even though I thought, you know, I can hold out 3 years, I can't hold out 3 years. So I'm going to sell it for $8,000, $9,000, $950, whatever I can get, I can sell it. I'm going to sell it so I can have that cash flow so that I can continue to live my life.
Oh, okay. So you might not take a hit, but it's pretty likely that you would, just because other people would be selling at the same time.
Well, you may not necessarily take a hit, right? Because the flip side to that may be, well, I can wait 3 years and get 10,000, but this $1,000 that's coming in every month, people are clamoring for that deal now. Or every year, excuse me, they're clamoring for that deal now. So I can actually sell this for $1,100 or for $10,050. So I'm going to sell it now, as opposed to waiting later. So it's still an investment. It still has risks associated with it, and you can buy and sell it whenever you like. I'm going to do one more example, and then after we do this example, we're going to go into some breakout rooms, and you all are going to get to do an example on your own. How exciting. Okay. So here, right, this is an example of a bond. Okay. It's paid semi-annually for 4 years, and it has a discount of 95.2, and it's purchased on April 1st. Okay. So corporations do bonds as well. This is MCD, is McDonald's. So we want to figure out what's the par, what is the coupon rate, what is the term, and what is the price. So let's see, what's the par?
10,000.
10,000. What is the coupon rate?
6%.
What is the term?
4 years.
4 years.
Yes. And the price?
Is that not given?
95.2.
95, yeah.
9,520.
Well, so now you're slightly ahead of me. So let's figure out the cost, right? So the cost is going to be the price times the par. So as Jasmine said, is what'd you say?
9,520.
520. Oh, I wanted to ask a different one. All right, that's fine. So that's the cost. How much interest are they going to earn each payment?
Par times the coupon rate.
It's the par times the coupon rate.
600.
600. Oh, I did not. This is my fancy. 600 every
Annually, right?
annually. How often are they getting paid?
Semi-annually.
Semi-annually. So it's going to be $300 per payment because they get paid twice a year. So it's $300 per payment.
I'm sorry, can you go over the 600 mathematically? Because like it's 10,000 times 0.6 or?
Yeah, it's 10,000 times, not times 0.06.
0, yeah, 0.06.
All right, and then let's also figure out what's going to be our, so it's a discount. We know it's a discount because it's less than 100. Okay, so anytime the price is less than 100, it's a discount. If it was greater than 100, it would be a premium. Okay. So this is a discount because 95.2 is less than 100. Less than 100. So how much are we going to amortize of this discount every time we get paid?
$120 a year.
$120 a year. I asked the question not knowing the answer, so let me do some math. $120 a year.
480, right?
So let's look at it this way. So we've got our bond investment that we paid $9,520 for. Okay. And 4 years from now, when it matures, how much are we going to get back?
10,000.
10,000.
Yeah, the difference is 480.
So the difference between this and this is $480 that we have to spread out between the number of payments that we have divided by the number of interest payments. So how many interest payments are we going to get?
4.
8.
8.
8.
Oh.
Right, 'cause it's going to be 4 paid semi-annually. So 4 times 2, 8. So 480 divided by 8 is 60. That's 60.
Yeah, 60.
Every time we get an interest payment, we're going to increase this bond investment by $60. We're going to do that 8 times until we get to 10,000. So now we're doing our journal entry. Or questions?
Wait, yeah. Where did you get the 480 from?
So this 480 is the difference between 10,000 and 9,520.
Oh, okay.
So now we're doing our journal entries. I'm just going to come back to here. This was on April 1st, 2020. We paid $9,520 for this bond investment. $9,520. And we credit cash $9,520. And then what happens in May? Correct. Nothing. What happens in June? Correct again. July, August, September, October. Like we missed something. Something happens, I think, on October 1st.
Is October 8? No, 10? October's 10, right?
Yeah. So April, May, June, July, August, September. September, we missed it. September's
10?
So April, all of May, all of June, July, August, September 1, something amazing happens. Or is it October? Am I doing my math wrong? All of April.
I think you're right with September.
It's September, since it's all of April.
It's all of April, all of May, all of June, all of July, all of August, all of September. It's October 1. It's October 1.
Oh, because
wait, Professor, why don't you pay at the end of September?
Because it says we're going to pay you every 6 months. So April 1st, January 1st. No, not January.
Oh, okay.
April 1st, you get paid, and when's the other time? October 1st, you get paid. So when it's time to get paid, we're going to get cash of $300. We're also going to increase our bond investment for $60, and our interest revenue is $360. So at the end, as of October 1st, the amortized cost that's reported on our balance sheet is $9,580. Question?
Yeah. So semi-annually is every 6 months?
Yes.
Every 6 months for the 4 years is when we're going to record it, right?
Mm-hmm. All right. So the 300 came from here. The 60 came from here. And then this 360 is just the sum of this and this gets us 360. So y'all know we got to remix it, right? So November 1st, what happens?
Nothing.
Nothing. December 1st, what happens?
Nothing.
Nothing. December 31st, what happens? Something, right? Because the fiscal year end is 12/31. So we got to make sure we're recording our financial statements on the accrual basis of accounting, which says record revenue when earned, okay, and expenses when used. So when we get to 12/31, even though the company that we're investing in is not going to pay us anything, they still owe us interest receivable, $150 in interest. That $150 is, let's go back here, the par times the coupon rate, right? 10,000 times 6% divided by 12, right? This is for the year. So divide it by 12 and then multiply it by how many months they owe us for. All of October, all of November, all of December. 3 months. I know someone saying, can't you just take 300 and divide it by 2? This looks so much more sophisticated, you know? But you can do whatever you want. We also have to increase our bond investment. By how much? Anybody?
30?
Yeah, 30. We're increasing it by $120, right? So it's 480, right? That's our discount. Divided by 4, that'd be for the year. Divide that by 12, multiply that by 3. Or just divide 60. In our interest revenue, all this so that we can say we recorded revenue when earned is $180 because that's what we've earned. Deep, baby. January 1, nothing happens. February 1, nothing happens. March 1, nothing happens. April 1st, what happens?
We get $300.
We get $300. Thank you. 4/1/21, they're going to give us $300. Thank you very much. We appreciate that. Oh, wait, I'm sorry. Before I do that, back up. $30 gets added here. So at 12/31, that's at oh man, that's some hard math. 9,610. Okay, let's go with that number. Then we're going to increase our bond investment by $30. Okay. We're going to record interest, or we're going to credit our interest receivable by $150, right? Because part of this $300 is what they owed us for that. And then we're going to credit interest revenue for 180. And then here comes the beautiful chaos. When we get to October of 2021, it looks like that. December of 2021 looks like that. April of 2022 looks like that. And then it just keeps repeating itself. All the way until we get to 4/1, I think 24, when we debit cash for 10,000, credit the bond investment for 10,000. I will pause there.
Mr. Bill, I'm confused. For 121, where did we get the 150 from?
This credit right here for 150?
Yeah.
So when they paid us $300, right? This $300 is covering the payment they owed us from October 1st all the way up until April 1st.
Okay.
So 150 plus 150. We already recorded this 150 to 1231. That's what this 150 is.
Yeah.
We put there, recorded it here, right? Part of that 180. This other from 1231 to 41 or 11 to 41, that 150 is part of this number here. Plus, and then plus the 30, because we were increasing this bond investment.
Okay.
All right, you guys ready? Try it. You're not. Okay, doesn't matter. You'll be fine. So why don't you guys take a picture of this, because I'm going to put you all into breakout rooms. Now, you're only asked to do two things. Record the initial purchase of the bond. So what's the journal entry on January 1, 2018? And then the receipt of the interest, so the interest payment on July 1st, 2018. So how much interest? So just two journal entries. Okay. I want to remind you guys, I'm going to put you in the breakout groups. There are, this is also ES-12 in your books, if you have your books with you. There are 37 of you. So we're going to go into, we'll just go in like 8 different rooms. So you can do a share, right? There's a whiteboard. So you guys can talk through it together. One person can share their screen, and talk through it. There's also, I don't know where, but somewhere there's a button you can push to ask me to come join your room. So I don't think I'm gonna have time to pop into everyone's room. So I'm gonna stay here in the main room. If you want me to come visit you, just kind of pop in there. Click a button, I don't know. All right, so let's do some breakouts. I'm gonna put us into 8 different rooms. I'm gonna stop that share. I'm gonna put us into 8 different rooms. Oh, it's suggesting 9 rooms. Oh, let's go 9 rooms. All right. Rooms are open. So if you're still in this room, you should not be. You should go to your breakout room. Brian, Michelle, Justin, Chris, Jeremy,
Can I just grab a picture of the problem real quick?
Yep.
Okay, perfect. Thank you.
All right. Hello?
Oh, there he is.
Hey, Mr. Bell.
Hey.
I just have a thing back to the example problem. Why did
All right. So would someone mind sharing their screen and showing us the answers that your breakout group received? Who would like to do that?
I could say it if that's easier.
No, it's not easier. You want someone to share the screen, write or type, or so we can see the numbers with the visualize it. Oh no, do a share screen. So there's a option to someone can share their screen. Thank you, Madison. Well, someone share their screen. Gone are the days when I could just walk into class and just hand you guys like FIFO cards and then like force you to get up, hand you a thing and just you're all excited when you get it, like, oh, and then you realize what it is. You're like, oh crap.
One sec, I'm writing all my math down and then I'll show you guys.
What happened to all those beautiful faces? I already know your guys' names. I don't need to see your names. Like, imagine if I did the whole class like this. You guys would be like, oh my God. This is how I feel when I look at all your guys' names. Just like, okay, I got it. Thank you.
I'm just trying to write it up on a Word doc really quick so that way I can show it.
Oh, thanks, Andrew. But we want someone to like share their screen. There's like a green button at the bottom, and you can share your screen, and you can do a whiteboard.
Oh, okay.
You can do There we go. Someone's there.
That's me.
I should have told you the whiteboard is very difficult to use.
Yeah. Let's try it.
Here you go.
Madison, you're probably going to be able to finish before I am.
You have to talk us through it as you're doing it.
So you take 60,000, and I'll show you how to get the 51,000, but I just kind of started here. But you get the 51,000 by multiplying 60,000 times 0.85, which is the price of the bond. I'm just going to do 60K. So that way. Multiply by 0.85 to get 51,000. And then you take 51,000 and you divide that, or no, 60 51 equals 9,000, 9K. And then you take 9,000, divide it by 20 years, because that's the end of the bond, the maturity date of the bond. Divide it by 20, and you get 450. Now, since this is compounded, or not compounded, but since it's a semi-annual bond, you divide this by 2 to get 225. Ah. 2, 5. No. And then once you get 225, so that's your bond investment value for this journal entry. So you do bond investment equals, and you debit that for 225. And you take, and then in order to figure out what you're debiting cash, you just do 60 times your interest rate of the bond, multiply that by 0.1, which is equivalent to 10%, and you get 6,000. But you still have to remember that this is compounded, this is a semi-annual bond, so you have to divide this by 2 to get 3,000. So this is what you debit your cash for. Cash.
I have it done too on the Word doc, just in case.
3,000.
He's killing it.
And then you just add these up, and you have to make sure your debits equal your credits. So all of this would be your interest revenue. So you do IR, you debit that for $3,225. So that's 3,225. And that would be your journal entry for 7. This is 7. This is 7, 3, 1, 18.
Let's all go to our reactions at the bottom of your screen. And let's give Andrew a round of applause.
Thank you. Thanks.
Thank you. That's all. I'll give him a round of applause. Did you get your round of applause?
Yeah, I did. Thank you.
Standing ovation. Let's do it again. Yeah.
Standing ovation. Thank you.
Questions? Other questions?
So I see that you use 10%, but it also had an interest rate of 12% in there as well. We use the market rate of 12%. Were we supposed to use 10%?
Let's see. Let's go back to
Yeah, I totally ignored that 12%, dude. It just seemed superfluous. I didn't know.
I know, yeah, we ignored it.
Yeah, I didn't. I just took the initial.
Is that because it's the rate you purchased it at, 10%?
Yeah, yeah. So that's. I mean, yeah. To be honest, I ignored that too, and I just paid attention to the first rate that they gave us, which is the 10% bond rate, because we want to look for like what it says. So it says 60% of 10% of AMS bonds on January 1st. So I kind of assumed that the 12% didn't really come into play. And so I think we could have also, if it asked something else then regarding, the price, or it said market rate of interest inside one of the questions of the problem, then we may have began to take that in. But since it didn't, I just went ahead and used the 10%.
Okay. Was that right, Mr. Bo? Were we supposed to use the 10%?
Yes.
Okay.
That 12% is just telling you what the market rate is. So it's saying that this company could take their $60,000 and go invest it somewhere else and earn 12%.
Oh, I see.
So why would they want to
sell.
do 10%? And that's why AMS is offering their bonds at a discount, because otherwise no one would buy the 10% bond.
Okay, thank you.
All right. Thank you again. That was good. So we're going to take a 10-minute break. I'm going to put on a timer. We'll take a 10-minute break, and then we'll come back. And I promise you, the next thing we discuss is easier than bonds. But, everything is easier than bonds. All right. So let us take a 10-minute break. I'm going to pause the recording. And I should point out, Andrew, as we were all watching Andrew struggle to use the whiteboard, I am not using Zoom's whiteboard. I'm using my iPad. It's somehow connecting magically or something. I can't use that whiteboard. So I was really impressed, Andrew. Thank you. All right. So we talked about 3 different types of investment classifications. Trading, right? Available for sale and held to maturity, right? And it all depends on what is management's intent and ability. And if they intend to hold it for a short period of time in order to generate a profit, it's considered a trading security. Okay? And it's reported at fair market value. And the difference between the last fair market value and the current fair market value gets recorded as a gain or a loss on the income statement. If it's held to maturity, if the company intends to hold the investment until it matures, right? So a bond, and that's their intent, to hold it till it matures, it's reported on the balance sheet at amortized cost. Okay? And that difference gets reported as interest revenue on the income statement. So let's talk about available for sale. Okay. And this is the one where management says we do not intend to hold it until it matures, or we do not intend to hold it for a short period of time. We do not intend to hold it until it matures, or we don't have the ability to hold it until it matures. So because I'm not an English professor or an English major, I can just say it this way. When it ain't this and it ain't that, then it's considered an available for sale investment. Management is saying, we don't intend to hold it until it matures, or if it's an investment in a stock, we don't have the ability to hold it until it matures because stocks never mature. And we don't intend to hold it for a short period of time. Okay. So when we do that, it gets reported as an available for sale investment. Let me pause for a second. Let's back this up a little bit, because I want to show you, you guys all remember the accounting equation, right? Assets equals
liabilities plus capital plus revenue plus gain minus dividends minus losses.
Yes. You guys all remember that? Hey, guess what? I want to add, we're going to add one more thing to that. As I can hear the collective groans above your muted microphones. Assets equals liabilities plus capital plus revenue plus gains minus expenses minus losses minus dividends plus or minus accumulated other comprehensive income. Accumulated other comprehensive income. So AOCI or OCI, other comprehensive income, this is a component of equity. And it's used to capture unrealized gains and losses.
Can you repeat what you just said?
It's a component of equity, and it's used to capture unrealized gains and losses.
Would you debit it to increase it and credit it to decrease, or the other way around? Or does it just depend on like whether it's, I don't know.
It's in equity, right? So OCI is part of equity. We normally increase equity with the credit. So for OCI, if it's other income, it's going to be a credit. If it's other loss, unrealized loss, it's going to be a debit.
Thank you.
Mm-hmm. Here's what's going on. Okay, so let me go back to whiteboard. So revenue, expenses, gains, losses, all this shows up on the company's income statement, right? And this is where we see the company's net income, the performance of the company. How well is the company doing, right? So this is a really, really important statement. But there's other things that the company is doing, right? Other activities that are taking place that should not affect the net income of the company. So what the accounting gods have done is they've set up this other account within equity, right over here. Can you guys see my mouse? Yes. Okay. They've set up this other account over here within equity, so the accounting equation remains in balance, but it doesn't impact our income statement right here. Okay. Doesn't impact the income statement. So, for example, a lot of companies, Apple, lot of other companies, right? They have businesses in the United States, in Africa, in China, in Ireland, right? And so the company has to create its financial statements in one currency, US dollars, right? So at the end of every period, they have to do a foreign currency adjustments, right? They have to take whatever the current translation is between, say, the euro and the US dollar, and they have to translate that to say this is the value of our asset now. Okay? So that's going to make your assets either go up or go down, but that has nothing to do with the true performance of your company. So as this is going up or down, right, this has to remain in balance. So your equity is going to either go up or go down. Okay, but it's going up or down here in OCI, not impacting the income statement. Another, go ahead. Yes.
So foreign currency. I think you were just about to answer my question. It's just an example of one of the comprehensive incomes or losses.
Yes.
Okay.
That's right. It's just an example. Another example would be gains or losses on hedging derivatives. And if you don't know what a hedging derivative is, I encourage you to ask your accounting professor when you take intermediate accounting. I'm not going to explain that to you right now. The other one is unrealized gains and losses on available for sale securities. Oh, finally, here we are. Okay. So these are three things where we're using other comprehensive income or other comprehensive loss to track the change in our fair market value. Okay. So I still have it. I have it right here. So available for sale securities are reported at fair market value, just like trading. Okay. But the difference gets recorded in other comprehensive income, okay? A component of equity. What questions do you have?
The difference of what? So the difference of the value we bought it at and then what we gained and lost?
Yes, the difference between, so fair market value, right, changes every day, right? The fair market, the market value of Apple stock on yesterday is different than what it is today. It may be a huge difference, it may be a very small difference, right? But it's changing every day. So at the end of every month, we have to, in accordance with GAAP, generally accepted accounting principles, report our balance sheet, on our balance sheet, are available for sale securities at fair market value. On that day, March 31st, what was the value, the fair market value or the market value of that investment? On April 30th, what's the market value? So every month it's going to be changing, right? It may change a little, it may change a lot. Other questions? All right, I told you this was easier than bonds, okay? Let me show you. So this is a similar example that we did in class. But when we were doing this, we were assuming that the company had the intent to hold this investment for a short period of time in order to generate a profit. So now let's assume that the company's intent is to hold this, is Well, it's not to hold it for a short period of time to generate a profit. It cannot be classified as a held to maturity because shares, equity investment shares don't have a maturity value, right? There's no date when they go, okay, Bank of America's closing, so everyone, here's your money back, right? There's no end date to it. So therefore we're going to account for it as an available for sale. So on January 15th, when we purchase it, we're going to record a debit to AFSS. I'm just abbreviating. This is our asset for our available for sale security. And if we bought 100,000 shares at $7, I believe that would be $700,000. And then we credit, every time we make an investment, it's cash, credit cash. Then when we get to January 31st, right? Oh, 700,000. When we get to January 31st, the Bank of America shares are now worth $7.50 each, which means that the fair market value should be 750, right? That's 750 times we own 100,000 shares. So how do we get from 700 to 750? We're going to add 50,000 to this. So we debit our available for sale securities by 50,000. So this should look familiar or somewhat remind you of the trading securities. Here's the difference. Instead of debiting gain on the income statement, we're going to debit AOCI, this equity account called AOCI for 50,000. And I think Madison was asking the question about how this works, right? So remember, assets equals liabilities plus owner's equity. So when I credit anything in owner's equity, right, it's making my owner's equity go up, just like my asset is going up. Questions? On February the 28th, the Bank of America shares are down, right? They're now worth 675. So if I multiply that by 1,000 shares, that would mean that my fair market value is 675,000. I'm not practicing social distancing with my T accounts here. No laugh on that, huh? Okay, all right. You know, I work on these jokes. I write them out.
I laughed. It was just muted.
Yeah, so did I.
All right.
I've been laughing for a lot of things. Just muted.
No, that was the first joke. You shouldn't have laughed at anything else, Romina.
Well, other things were funny. How you added another thing to the equation. I was like, seriously, I can barely remember.
Oh, okay.
And the in-class jokes, those were always fire.
All right, you guys are trying to get extra credit, and it's working. It's all working.
12 points would be cool. No, I'm kidding.
All right, so to get to 675, that means this has to get reduced by, what was that, 75? So I credit AFSS for 75K. And my debit is just AOCI. 75K, 75. So now, well, yeah. So now my overall equity has gone down 25,000, right? Which reflects what my asset as well has dropped from 700 to 675. The only difference, you guys, is that these ups and downs are not being reflected in the income statement. Let me throw a monkey wrench in here. Let's say on the 15th, Bank of America paid 50 cents in dividends. Right, and since we own shares, we're going to get those dividends. When we receive dividends, regardless whether it's trading security or available for sale, we're going to debit our cash and we're going to credit dividend revenue. Now, I need to break out my calculator for this one. I shouldn't have to, huh? I will. Hate to embarrass
Just to be sure, yeah.
100,000 times 50 cents, 100,000 shares, 50 cents each share. That's $50,000. That was too much of a dividend. $50,000 of dividends. My point is that this dividend revenue here, this dividend does not impact this. Okay? Just like when we receive dividends for stock that we own, it doesn't make, they don't take any stock away from us. They're just giving us money. Finally, any questions on that?
Wait, Professor, why don't you credit AFSS, but instead you credited dividend revenue? Why is that?
Because when we received 50 cents in dividends, it didn't impact the 100,000 shares that we own. We still own the 100,000 shares, and that's reported at its fair market value of 675.
Wait, so where'd you get the dividends again?
Oh, I just threw that into the problem.
Okay.
So
it's 50 cents per share.
And those dividends would be reported on the income statement then?
Yes.
Okay.
This would be like a gain.
Got it.
So the last thing is on March 31st, and when we sell them at 725. Now, I like to do this in two steps because I think it's easier to kind of think of it this way. So one, let's get our AFSS to its current market value, which is 725 times 100,000, 725,000. So that means we need to add 50 here. Okay. So debit AFSS for 50,000, and the credit goes to AOCI for 50,000. Okay. So that leaves us with 25,000 now in our AOCI account. Then we sold everything, right? And we sold it at 725. So when we sell it at 725, this is also on 331. We're going to debit our cash, okay, for what we received, 725,000. Right? We're going to credit this AFSS because we sold everything for 725. So now that's at 0. But when we get rid of this account, we also have to get rid of this account. Okay. So we're going to debit our AOCI for 25,000. Okay. And we're going to credit gain on sale of investment for 25,000. So this is the last journal entry that we do. We're just clearing off this AOCI account to get that to 0. Okay, and recording it as a gain.
And that's a realized gain, right? Not an unrealized gain?
It is a realized gain, yes. Questions? Here's the big difference between trading and available for sale securities. When you go back to your notes and you look at what we did for trading, you're going to see that there was a $50,000 gain in month one, or increase to our net income in month one. And then a $75,000 decrease to our net income in month two. And then a $50,000 increase to our net income in month three. And that's confusing to an investor, because this has nothing to do with our normal business, right? Our business is selling whatever we sell, furniture, whatever, right? So by taking all the ups and downs, the gains and the losses, and just placing it over here in this component of equity, right? And saying, once we know exactly what we either lost or gained, that's when we're going to move it into the income statement. Okay? So you'll see a lot of companies use this this approach of recording their investments as an available for sale security. Questions?
Why aren't the other like stocks and normal trading securities, why don't they use this method? Because you see the gains and losses on the income statement pretty much right away, don't you?
If you use trading, you see the gains and losses right away. But if I'm a business, right, and I'm investing my excess money, I don't want you making decisions about my business, right? Let's say I'm in the furniture business. I'm in the business of selling red calculators. I don't want you basing your investment decisions on something other than me selling red calculators, right? And so when there's a significant gain, right, stock market goes up, it makes my income statement look good, but that has nothing to do with my ability to sell calculators. When there's a significant loss in the stock market, it makes my income statement look real bad, but hey, that has nothing to do with my ability to sell calculators. I'm still really good at that. So by using the available for sale approach, you're just hiding all that activity, the gains and the losses, in equity until the loss or the gain becomes realized or real. And at that point, that's when you bring it into the income statement.
Thank you.
All right, let's do some polling. Launch a poll here. Let me know if you see it. Question is, what are the 3 classifications for investments? Madison, were you able to figure out how to see polls?
Oh, I've done everything that anybody else has, tried to tell me to do, and I can't. I don't know if it has to do with the fact that I'm using Zoom from my browser and not downloading it to my computer, but
You should download it.
I don't see the poll though either.
Yeah. No one sees this poll that's up and running?
I don't see it.
Well, apparently, yeah, no one's voted. Okay, let's relaunch it.
There we go.
There you go.
Yeah.
There we go. Madison, any luck?
nope. I'll have to download it then on my computer whenever I get the time, probably later today.
So the question is, what are the 3 classifications for investments?
Real quick, what the polls up. I was a little late to the Zoom meeting. Did you go over about the Parsons not working last night?
Oh, the My Accounting Lab?
Yeah.
Yeah, yes, I did. So everything that was due today has an extended deadline of Thursday at 10 o'clock.
Okay.
But I encourage you to finish it because there's also more homework that needs to be done. And so we never know what's gonna
break down again.
When it's gonna break down again.
Is the site back up again?
It is up.
Okay.
This
Yeah, I
morning.
was doing a little bit of the homework this morning.
If anyone, yeah, okay, I'll say that. All right, 78% voted. The other 22%, you have 22 seconds to vote.
But I already voted.
Well, I wasn't talking to you. Talking to that 22% that did not vote. All right. They're just not going to vote because no movement. And most of you nailed it. You can see the results there. Trading, available for sale, held to maturity. Or if you want to be fancy, I think the fancy was maturity. Maturity. Yep. We got another poll. Stop sharing that one. And let's launch this poll. I think this one has 4 questions on it. Can you guys see that? Yes, okay. First question is, what are trading securities reported at on the balance sheet? Second question, what are available for sale securities reported at on the balance sheet? Third question, what are held to maturity investments reported on the balance sheet? And the fourth question is, what are all investments initially recorded at on the balance sheet? And the answers are dripping in, slowly dripping in. Now they're flooding in. Waiting on 25% more of you to vote. So I guess I should give you 25 seconds.
Does your BB-8 actually work? Like walk
This
around?
guy right here? Yeah. Yeah, he does.
Yeah.
This is like some serious Star Wars stuff. All around me. I don't even know how it all got here. You know, it's just here. Okay. Let's see how we did. Poll is ended. The results are being shared. So trading securities are reported on the balance sheet at fair market value, says 52% of you who are correct. Available for sale securities are reported on the balance sheet at fair market value. That is correct. Held to maturity investments are reported on the balance sheet at amortized cost. And all investments are initially recorded. So when we first say debit the investment, credit the cash, it's reported at, the correct answer is, in my opinion, historical cost. But I also have to give respect to those who said fair market value, because fair market value is the historical cost on the date that it's purchased. So let's just say 75% of you guys got that right. Questions? This was a heavy